Hey, everybody, it's Pete Carmasino here at Chaikin Analytics. I am the Chief Market Strategist here, and this is the halftime show here on Stockcharts TV, so thanks for joining in. And, we've got a bit of an ugly market here today. Dow down over 400 points right now. Nasdaq down about 60 and some change. That's about 1.5%. Nasdaq down also about 1.5%, about 176 points. And the Russell 2000, the small cap names, trading down about 2.25. So getting hurt a little bit more. I mean, look. Interest rates are kind of the blame here. We know what's happening. We know that it's been an interesting last 2 to 3 months. We've seen some names really rise into this, the face of what's happening here, the face of uncertainty in a way. And then, we're seeing, the markets sort of reassess things, potentially looking at a recession. The 2s and 10s have been calling for this for a while. I've got an interesting chart I'm going to share on that. I'm not exactly, married to this idea of the way I charted this, but I thought it was interesting, and I'm willing to share it. So I'll do that. And then I'll look at the sectors today as well. And then I'll look at some names that have done well in the last 3 months on the S&P 500. I think some of the names will surprise you. You'll see some travel names in there. You see some biotechs. You see some hotel names, metals and mining, discount retailers. It's been a mixed bag, and a lot of these names were oversold. A lot of people are looking at, more of a value type trade, and I can't disagree with that as well. But at the same time, I think it's sort of, critical that we look at the way things are kind of playing out here in the markets. And when I say that, I put a forecast out last week, that was kind of looking at the head and shoulders pattern, the last head and shoulders pattern that was created. I had a neckline of around 3,800. I had a top line. I forget exactly what the number was, but we'll look at it today. And I had numbers kind of, I want to update those numbers today. So I'm going to update that chart so you can take a look at a fresh view of that downside. And the interesting part is over the weekend, one of the strategists at Bank of America came out, similar kind of targets, but had a really interesting point. And again, it was the Bank of America strategist. Let me give you his name here. It's Steven Sudemeyer. I apologize if I'm mispronouncing that. But he had an interesting point. He said, markets don't tend to bottom before recessions. They tend to bottom during the recession. I like that. And I think it's an interesting take. Now, the interesting part is a lot of people are coming up and formulating these targets at very similar areas, including me, but for different reasons, using different types of techniques. Now, I don't know if it's a self-fulfilling prophecy, but my point to you is that there's a lot of paths that are leading to potentially a lower low, and no one is saying that will be the bottom. We hate using that word because we just don't know. But when you use a projection instead of a prediction, it gives you the ability to kind of be more flexible, not only in your trading and your investing, but just in the understanding about what's happening, the mechanics of the market. And I think that's really important. So let's look at, some names here today. We're going to look at the sectors like we normally do. We're going to look at the top performing names in the last 3 months of the S&P 500. And then we're going to look at this quirky chart that I built on the 2s and 10s spread. And I'm going to share an article today, also just a quick one that, our founder, Mark Chaikin, kind of noted about, and it has to do with the 2s and 10s as well. So let's take a look at the charts and see what we see. Okay, folks, we're back here at the sort of the dashboard of our system. And, we've got a lot of widgets here, and it's kind of fun to use. And one of them is this tracker, this movement percentage over the last 3 months. And you can change that, or you can use a 1 month, a 1 week, a day, 1 year, 6 months. I'm just using 3 months because I just thought it was interesting, like names like Biogen, and then right below that is not a great rated name. That's a neutral negative for us, but that's Royal Caribbean. And then you got Dexcom, then you got Wynn and Netflix. What a mixed bag, right, of performers, all the way down to even the online retailer Etsy. And then you got a discount retailer Ross right near it, both up over 30% in the last 3 months. Pretty big moves. Now, the charts don't reflect, very attractive type patterns, but a lot of them did. and are still looking very interesting. And so the issue that we kind of face here is trying to thread that needle of, do we stay invested? Of course we stay invested on a longer term basis, but if we're being more tactical, there's different pockets of the market that are talking about. And again, going back to that idea of recessions bottoming, markets bottoming during a recession versus before, I think that's really interesting, and I like the idea. And again, Bank of America strategist Steven Suttmeyer has kind of made that prediction. That's kind of live out there in the markets right now. So, interesting take. I like the idea. So, this is the article I said I wanted to share. This is Mark Chaikin. This is our PowerFeed. You should totally check this out. You can apply or subscribe to it. It's only it doesn't cost you anything, really. It's free, but it comes out on a daily basis. Mark had kind of noted about the idea of the yield curve, right? And you're talking about that 10 and 2-year spread, and that's kind of interesting when you consider the fact that that is what is sort of moving people to the point of calling it a recession, right? I mean, that's kind of interesting. And so I think, or a recession predictor, right, so to speak. And the smart money is, has been moving out of cash and kind of moving into that longer term area where, remember, rates and bond prices are inversely related. So if the 2-year is yielding more than the 10-year, think about that for a second, right? In other words, people are less willing to be short term, right? Because if yields on the 2-year are rising faster than the 10-year, that means the bond prices on the 2-year are falling faster, right? And so people are kind of shunning that short term and feeling that you're better off on a longer term basis. Again, there's all types of things you can take away from that. And we're not trying to focus on one or two things here, just looking at the big picture, looking at the macro setup. And I think you've got to keep that in perspective. And so, when we look at names like this was a name that we had talked about, newsletter that you can get from us, powerfeed.com. And, I'd pointed this out at around, I don't know, 210, 220, something like that. And the stock had moved all the way up to, a pretty big number. I think it got over 300. So if I just click on that from our widget, it takes us right to Biogen, shows us that it's a very bullish name. But I was talking about it here. Now, I was way early on the name. It pulled back. It held that area of support that we would have used, sort of that, that previous low in that range, so to speak. And it kind of hugged our long-term trend. And then there was some news that came out. I believe it's an FDA approval. The stock traded all the way above 300 to 310. And so it was a pretty big move quickly. And look at like Royal Caribbean now, not a great fundamentally rated name, but from the lows of, say, that roughly $36, $37 area, it had traded all the way up to 60, 61 and change. That's pretty impressive. I mean, for a name that's in trouble now, the relative strength change happened in this level, somewhere around that $50 level, and it moved another 10 points. Now, a little late, obviously, but more cautious than anything. And I think that's kind of the way you've got to play these types of markets. These are bear market rallies. They're kind of hard to predict, and they're hard to kind of navigate. The good news is you just don't have to be in every name that's breaking out and showing a quick signal here and there, right? So just take your time and be very patient, so to speak. All right, we're back here just looking at the ETF comparison. I wanted to kind of jump over to this area as well to look at how the industries are kind of shaping up on our system. So you've got industrials at the top, and the bottom industry is real estate at this level. Now, this is ranked by the rating. All right, if I rank it by the power bar, I can see sort of what's happening in the last couple of days here. You see XLP moving up from 4 to number 1. Now, that's ranked by the power bar. That means the number of bulls to bears. There's 0 bears in XLP at the moment. Now, this one also moved from a rank number 5 to 3 as well in the weekly gainer. So you're seeing consumer staples, healthcare, and even, believe it or not, some of the technology names. So again, that's sort of an interesting level. We're still neutral on that particular group. And I just think it's important to kind of point it out and kind of follow that, what's happening there. I talked about the sectors. So let's go take a look at some of the names. We're going to run through these really quickly. XLY is still on a downtrend. Here's XLV. Now, this is the one that moved up recently. Check this chart out. We talked about this, again, a defensive sector, and it looks pretty good. And so it's been running, hot in the last couple of months here. Real estate, we just saw that it's ranked as our lowest one on our rating, and rightfully so. It's underperforming the market and kind of dragging things along. Here's XLK, and then I'll look at XLP in a sec. XLK had an interesting, area where it kind of bottomed at around that 115 and traded all the way up to about 137 or so, but still in a downtrend, having trouble getting above that 200-day, and it looks like that's going to be resistance. But XLP, one of the ones moving into the top spot based on our power bar rating, is actually experiencing a pretty interesting change here. Again, relative to the SPY, it's been an outperformer in a defensive nature. We talked about this last week. Absolutely, from an absolute perspective, it hasn't really created any gains, but it really has protected on the downside versus the S&P when you look at that. But now you're starting to see this change to the upside pretty dramatically, and perhaps we're getting across on the 50 to 200-day to the upside once again. And so a lot of this is pointing to people getting defensive and kind of, concerned about what's happening out there in the market. Let's go look at this Head and Shoulders setup that we had talked about last week. Sorry, I clicked on the wrong chart. And I got to adjust these because, I needed a little bit more space to build some of this because of the way I wanted to kind of portray this as another setup, right? So the pre-pandemic high is about that 3380 or so. My target's around that 3275 to 3300 level, and I've got it out until April. The neckline's 3800 and the top line's 43. So it's about a 500 point gain. Now, I miscalculated that last week. I had 410, so I'm just updating this here. I just wanted to be clear about what we're doing. But again, this kind of lined up like it did before. Our target was 3750. We traded all the way down to 3500, 3490 or so, and then rebounded. But then we built this pattern once again. And so I know it's a stretch, but I'm seeing it, and I want to call it out. And it's concerning. So, I think at the same time, you're starting to see a lot of folks call 3,300 for different reasons, right? $200 of earnings on the S&P at a 15 PE gets us to 3,000 or so. Different PEs, different target earnings will get us in those ranges of 3 to 3,300 or so. But everyone's kind of in that area. And I don't know if the pre-pandemic high is going to be that big of a support area. If we trade that low, again, it would be only 100 points below the previous low, roughly about 110. But I think it's I think it could be an opportunity, but I also think it's an option for the markets, as well. Lastly, I wanted to share this chart. This is the 2s over the 10s, and just kind of seeing how this spread has progressed. Now, a lot of people can do this, different ways. I just chose to look at it this way on the ratio area, because when I take that ratio and create another ratio on the SPY, I told you this was quirky, I could see how it has started to outperform the SPY. And I just used this area as an area of previous resistance. This was about a year ago, about November 12th, roughly 2021, maybe call it the first week. And it just had trouble on the S&P breaking that high. And I just wanted to correlate it to the 210 spread to see if there was any kind of opportunity to kind of make a prediction here. The only thing I see is about a 1 month lag. When this hits a new high, the markets tend to trade lower about a month later. So that's really one of the takeaways I wanted to share. Okay, unfortunately, I ran out of time as usual. So we'll be back next week. Thanks for tuning in. I'm Pete Carmasino. Have a great week.
Hey, Grayson Rose here with Stockcharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.